Two people invested the exact same amount of money for the exact same number of years, and one of them ended up with $1 million more than the other. It wasn't luck, it wasn't a better stock pick, it wasn't a secret app. Same income, same $500 a month, same 30 years. One of them is going to feel richer almost immediately. The other one is going to feel like nothing is happening at all. But by the end of this video, you'll see exactly which one built real wealth and which one only felt wealthy. I'm WealthCat, and this is the dividend stock versus index fund experiment that most people get completely backwards. Meet Dividend Dana, age 30. She just read that dividend stocks pay you cash just for owning them. To Dana, that sounds like the smartest money move in the world. Get paid to be an investor. Meet Index Ivy, also 30. Same job, same salary, same $500 a month to invest. Ivy picked a total market index fund. No dividends showing up in her bank account, no exciting news, just a number that quietly changes every day. Dana builds a portfolio of high dividend-paying stocks, utilities, telecoms, real estate trusts, anything with a big yield percentage next to it. Ivy puts her $500 into one boring diversified index fund and sets it to automatically reinvest. Then she basically forgets about it. For the first year, Dana feels like she made the better decision. Every quarter, real cash lands in her account. Ivy has nothing to show for it except a number on a screen. This is where most people's instincts start leading them the wrong way.
Here's what a dividend stock actually is. A company shares part of its profit with you, in cash, usually every 3 months. It feels like free money. It is not free money. When a company pays a dividend, the stock price drops by roughly that same amount. You're not getting extra value, you're getting your own money handed back to you. Here's what an index fund actually is. Instead of one company, you own a tiny slice of hundreds or thousands of companies at once. Some of those companies also pay dividends, but instead of mailing you the cash, the fund automatically buys you more shares with it. That single difference, cash in your hand versus shares bought automatically, is the entire story of this video. Because here's the trap. When Dana gets a dividend check, she has a choice to make: reinvest it or spend it. And every single time you choose to spend instead of reinvest, you're not just spending that dollar. You're spending every dollar it would have become over the next 25 years. A single $100 dividend spent today could have grown into over $1,700 by year 30 at a 10% return. Ivy never gets that choice. Her dividends are reinvested automatically before she can even see them. Discipline isn't required. It's built in. Dana has to make the right choice 50 times a year for 30 years without ever slipping. That's not investing. That's a willpower marathon. And there's a second trap waiting for Dana, one that won't show up for another 10 years. Year 5, Dana has received $9,400 in total dividend checks. It feels amazing. She reinvests some of it, but this year she used $2,000 of dividend cash for a vacation. It's not really my investment money, she tells herself. It's a bonus. Ivy's account shows $37,200. No checks, no bonuses, just a slowly climbing number she barely looks at. On paper right now, Dana's total portfolio is actually slightly ahead, $38,100 versus Ivy's $37,200. If you stop the story here, you think Dana made the smarter choice. This is exactly the moment where most people decide dividend investing is superior and stop paying attention to what happens next. Year 10. Dana wants more income, so she does what feels logical. She moves money into stocks with even higher dividend yields, 6%, 8%, even one paying 11%. Here's the rule nobody told her. A dividend yield that looks too good is usually a warning sign, not a bonus. Sky-high yields often mean the stock price already crashed or the dividend is about to get cut. Ivy does nothing different. Same index fund, same $500, same automatic reinvestment, month after month, completely unaffected by headlines. Dana's portfolio, $94,800. Ivy's portfolio, $103,600. The gap is small, but it's no longer in Dana's favor. And she doesn't know it yet, but she just built her portfolio out of exactly the kind of stocks that break first when the economy turns. She's been trading long-term growth for short-term cash, 1 quarter at a time. In 3 years, the bill for that trade is going to come due all at once. Year 15, a recession hits. Real estate trusts, energy companies, and high-yield stocks, exactly what Dana is loaded with, get hit hardest. 3 of Dana's biggest holdings announce the same painful news: dividend cuts. One of them slashes its payout by 50%. Another cancels it completely. Her reliable income just became unreliable at the worst possible time. Her stock prices fall an average of 42%. Ivy's diversified index fund isn't immune. It drops 35% too. Nobody escapes a real recession. But here's the difference. Ivy's fund holds thousands of companies. When the weak ones get crushed, the strong ones, the ones adapting and surviving, hold the line. Dana, now afraid, and with her income cut in half, does something millions of investors have done before her. She sells some shares to cover bills, locking in her losses at the exact worst moment. Ivy does the opposite. Her $500 a month keeps buying automatically, at crash prices. She's not being brave, she just never had to make a decision at all. This is the single most important month in the entire 30-year story, and neither of them even realize it yet. Dana's portfolio, $126,000. Ivy's portfolio, $189,000. The gap just tripled.
Year 20. Markets recover, like they always eventually do. Ivy's portfolio recovers fast and then keeps climbing because every one of those crash price shares she bought at the bottom is now worth far more. Dana's portfolio recovers too, but slower. She sold shares near the bottom, so she owns fewer shares to ride the recovery. She's compounding on a smaller number now. Dana's portfolio, $301,000. Ivy's portfolio, $498,000. Dana switches strategy again, moving back towards safer dividend payers, but the damage from years 10 through 15 is already baked in. This is compounding working exactly the way it's supposed to, relentlessly rewarding whoever stayed in the longest with the most shares. And the next 10 years are where that math turns from a gap into a canyon. Year 25. Ivy's portfolio crosses $812,000. She still checks it maybe twice a year. Dana's portfolio sits at $410,000. She's still receiving dividend checks, but on a much smaller base of shares than she would have owned if she'd never sold and never chased yield. Dana has technically collected more total cash over the years, roughly $61,000 in dividends spent along the way. But that spent cash is the exact amount that never got the chance to compound. Money spent early is the most expensive money you'll ever spend. She starts running the numbers herself for the first time. The math isn't in her favor, and it's too late in the timeline to fully fix it. 5 years left. The final gap is about to reveal itself. Year 30. Both investors have put in the exact same amount of money from their own pocket, $180,000 over 3 decades. Index Ivy's account, $1,150,000. Dividend Dana's account, $150,000. The difference between them, exactly $1 million. $1 million, not from a better salary, not from a smarter stock pick, not even from a fundamentally better investment type. $1 million, created entirely by what each of them did with the money along the way. Same amount invested, same 30 years, a $1 million gap. Here's what this story is not saying. Dividend stocks are bad and index funds are magic. Plenty of dividend investors who reinvest every payout, ignore the yield-chasing trap, and stay invested through crashes end up just as wealthy as any index investor. The asset class was never the real variable in this story. The behavior was. Ivy won because her plan removed decisions from her hands. Automatic investing, automatic reinvestment, zero panic in the crash. Dana lost ground every time she made an emotional choice. Spending bonus cash, chasing a bigger yield, selling out of fear. If you remember one thing from this video, remember this. The account that makes you rich isn't the one with the best-sounding strategy. It's the one you never interrupt. If this changed how you think about dividends versus index funds, hit subscribe. WealthCat breaks down one real money experiment like this every single week. And drop a comment. Would you have made Dana's choices or Ivy's? I read everyone.